Meet Bull. Bull thinks valuing a stock is simple. He Googles P/E ratio is the way to determine the value of a stock, squints at the number, and decides whether it's cheap or expensive. That's like judging someone's entire personality based on their height. Tall? Must be CEO material. Short? Nah, pass. Welcome to the genius world of retail investing. The truth? Valuation isn't one number. It's more like buying a used car. If you only check the mileage, you're ignoring the engine, the brakes, and the fact that it smells like 3 generations of wet dogs. Just one number won't save you. And spoiler, the market definitely isn't handing out refunds. So let's fix this, because different stocks demand different ways of looking at them. Think of it like dating. You wouldn't judge your grandma's bingo partner the same way you judge a 19-year-old TikToker promising to disrupt the world with AI smoothies. Same thing with stocks. Let's start with the dividend staples. Think Coca-Cola or Johnson & Johnson, the reliable, pays rent on time types. Here, the first thing you check is the dividend payout ratio. Formula is simple: dividends divided by net income. If it's over 100%, they're literally paying you with money they don't earn. That's like living off credit cards just to flex a new Gucci belt. A healthy range? Usually 40 to 60% for stable companies. Enough to reward you, not enough to bankrupt them. Next, debt to equity. Its total debt is divided by shareholders' equity. Basically, how much they borrow versus how much they own. Under 1 is usually safe for big stable companies like J&J. If it's 3 or 4, you're looking at a business that's more credit junky than dividend king. And when the bill collectors come, your dividend's the first to vanish. Finally, return on equity, ROE. It's net income divided by shareholder equity. In plain English, how good is management at turning your money into profit? For consumer staples, 15 to 20% is solid. If it's under 10%, that's an intern pretending to be Warren Buffett. Now, let's move to the growth rockets. Tesla, Nvidia, Shopify, the promise you the moon types. The first number you want is future revenue growth compared to the industry. If the stock is priced for 40% growth, but the industry is crawling at 10%, yeah, that's like a guy telling you he's NBA ready while shooting 5% from the free throw line. Another check is the price to earnings to growth, PEG ratio. It's price to earnings divided by growth. If it's above 1.5, you're probably paying way too much. It's avocado toast at $18, a bad trade no matter how good it tastes. And don't forget future return of equity, ROE. If the industry averages 12% and your stock's forecast is 25%, that's a rocket ship. If it's lower than peers, more like a bottle rocket, loud, flashy, but fizzles out before liftoff.
And then we've got the asset heavies. Think banks, airlines, or even MicroStrategy, which at this point is basically a Bitcoin ETF with a desk job. For these, book value per share is your starting point. That's assets minus liabilities divided by shares. In plain English, if they sold everything they own and paid off debt, this is what's left for you. If you pay below book value, maybe it's a deal. Pay way above, and congrats, you just overpaid for their office chairs. Next, debt to assets. Formula: total debt divided by total assets. For banks and airlines, it runs high. But if you see 0.7 or above for an airline, that's like owing more on your plane than it's worth. Basically, your dividend seat just got downgraded to baggage claim. And for banks specifically, net interest margin. Formula: interest income minus interest expense divided by earning assets. Around 3 to 4% is healthy. Under 2%? That bank's squeezing pennies harder than your grandma with coupons. Over 5%? Either they're extremely profitable or running a loan shark operation. And remember, metrics alone don't tell the whole story. A stock can look perfect on paper until you see management making decisions like it's an episode of The Office. That's why you also check fundamentals like insider selling, management quality, and the actual business model. Feeling overwhelmed? Tools like Simply Wall Street has pulled it all together. Dividends, health, past, future, valuation in one clean visual. It's like checking a FIFA or a Pokemon card. You see all the attributes like speed, stamina, and passing, and instantly know if the guy's a beast or belongs on the bench. Yet you can dive deep into every dimension without having to memorize all the formulas and definition. So, what about you? When you size up a stock, what's the first thing you check? Don't be like Bull, unless your goal is to star in the sequel to How I Lost Money in 30 Seconds.